What is fundamental analysis? Welcome back to Traders Wealth Academy. If you're new here, a special welcome to you. Today, we're diving deep into the world of fundamental analysis. Trust me, you don't want to miss this. These insights can help you navigate the financial markets and potentially make money. And remember, we regularly share valuable content like this on our channel, so hit that subscribe button and turn on notifications. Fundamental analysis is all about understanding how global economic news and events impact financial markets. It's like being a detective, piecing together clues to see the bigger picture. We're talking about everything from economic announcements and federal policy changes to company earnings reports and social forces. In the Forex market, one of the most critical pieces of data is a country's interest rates and its interest rate policy. Imagine you're trying to gauge the health of a tree. You don't just look at its leaves, you consider the soil quality, weather conditions, water supply, and other factors that affect its growth. Similarly, fundamental analysis looks at the overall economic environment to understand how it will affect currency values. Think of it like a weather forecast for the economy. Just as meteorologists predict the weather based on atmospheric data, fundamental analysts predict currency movements based on economic data. If a country's economic outlook is sunny and bright, its currency should strengthen. A strong economy attracts foreign investment and businesses, meaning foreigners need to purchase the country's currency to invest or start businesses there. This increased demand for the currency reduces its supply, driving up its value. For instance, consider the Australian economy. If it's gaining strength, the Australian dollar will likely increase in value relative to other currencies. This is because, as the economy grows, the country often raises interest rates to control inflation and support sustainable growth. Higher interest rates are attractive to foreign investors, who will need to buy Australian dollars to invest in Australia. This increased demand boosts the currency's value. Major economic events in Forex. Let's dive into some key economic events that drive Forex price movements. These events are like the major plot twists in a thrilling novel. They can significantly shift market sentiment and currency values. Gross Domestic Product, GDP. Think of GDP as the report card of a country's economy. It measures the total monetary value of all goods and services produced over a specific period. Released at 8:30 a.m. Eastern Standard Time on the last day of each quarter, it reflects the previous quarter's activity. A growing GDP indicates a healthy economy, typically leading to a stronger currency. For example, if the GDP report shows significant growth, it signals that the economy is doing well, likely increasing the currency's value. Imagine you're a farmer, and your yearly harvest doubles. This boom in production indicates good farming practices, just as a rising GDP indicates a strong economy. Trade balance. Trade balance measures the difference between a country's exports and imports. A positive trade balance, more exports than imports, suggests that a country's products are in demand globally, which can strengthen its currency. For instance, if Japan's exports significantly exceed its imports, the Japanese yen might appreciate due to increased foreign demand for Japanese goods and consequently the yen. It's like a store that sells more products than it buys, indicating high demand and profitability. Consumer Price Index, CPI. CPI is like a thermometer for inflation. It measures the average change over time in the prices paid by consumers for a basket of goods and services. Released around the 15th of each month at 8:30 a.m. Eastern Standard Time, it reflects the previous month's data. Rising CPI indicates increasing prices, which can lead to higher interest rates to curb inflation, potentially strengthening the currency. Think of it as tracking the price changes in your grocery shopping each month. If prices keep rising, it indicates inflation. Producer Price Index, PPI. PPI, along with CPI, is a key measure of inflation, but it focuses on the wholesale level. Released during the second full week of each month at 8:30 a.m. Eastern Standard Time, it reflects the previous month's data. While CPI measures what consumers pay, PPI measures what producers receive for goods. A rising PPI suggests higher future consumer prices, which might lead to higher interest rates. Imagine you own a bakery. If the cost of flour from your supplier increases, you might eventually need to raise your bread prices, indicating inflation at the consumer level. Employment indicators. Think of the employment report as a pulse check on the labor market. The most important announcement occurs on the first Friday of every month at 8:30 a.m. Eastern Standard Time, including the unemployment rate, new jobs created, average hours worked per week, and average hourly earnings. Known as the Non-Farm Employment Report or NFP, it often causes significant market movements. For example, a drop in unemployment or a large number of new jobs created can signal economic strength, boosting the currency. It's like a factory hiring more workers because of increased demand for its products, signaling economic growth. Durable goods orders. This report measures spending on long-term goods expected to last more than 3 years, like appliances and cars. Released around the 26th of each month at 8:30 a.m. Eastern Standard Time, it provides insights into future manufacturing activity. Higher durable goods orders indicate increased consumer confidence and economic strength, potentially leading to a stronger currency. Think of it as a barometer for consumer confidence and long-term investment. If people are buying more cars and washing machines, it signals economic optimism. Retail Sales Index. Retail Sales Index measures sales within the retail sector, from large chains to small stores. Released around the 12th of the month at 8:30 a.m. Eastern Standard Time, it reflects the previous month's data. Strong retail sales indicate consumer confidence and spending power, which can boost the economy and strengthen the currency. It's like counting the number of customers in a store. More shoppers indicate a thriving business. Housing data. Housing data includes new home construction and existing home sales. Residential construction is a major economic driver, and strong housing data indicates economic strength. For example, an increase in new home starts or existing home sales suggests a growing economy, which can lead to a stronger currency. Think of housing data as the foundation of economic growth. More homes being built and sold indicate a healthy economy. Interest rates. Interest rates are the heartbeat of Forex markets. Central banks, like the Federal Reserve, adjust interest rates based on economic indicators to control inflation and support growth. Higher interest rates attract foreign investment, increasing demand for the currency. For example, if the Fed raises rates, the US dollar might appreciate as investors seek higher returns. It's like offering higher interest rates on savings accounts to attract more depositors. Technical analysis versus fundamental analysis. Technical analysis and fundamental analysis are the two main approaches to trading and investing in financial markets. Imagine fundamental analysts as news reporters who focus on economic news, while technical analysts are like detectives who study past price movements to predict future trends. Fundamental analysts believe that economic news and events are the primary drivers of market movements. For example, a country announcing a significant increase in GDP or a central bank raising interest rates can lead to currency appreciation. They argue that understanding these fundamentals allows them to predict market movements. Technical analysts, on the other hand, believe that all necessary information is already reflected in the price charts. They study patterns, trends, and historical data to make trading decisions. For example, if they see a consistent upward trend in a currency pair, they might predict that this trend will continue. One common argument against technical analysis is that past price data cannot predict future movements. However, technical analysts counter this by pointing to the significance of support and resistance levels. These levels are like invisible walls on a chart that the price has difficulty breaking through. For example, if the price of gold consistently bounces off a certain level, it indicates strong support or resistance. Fundamental analysts might argue that impending news events are better predictors of market movements. However, markets often react unpredictably to news. For instance, if the market expects 100,000 new jobs to be added and the actual number matches this expectation, the market might still move lower because it had already anticipated this news. In conclusion, both approaches have their merits. Fundamental analysis provides context and understanding of why the market moves, while technical analysis offers practical tools for trading based on price movements. Many traders use a combination of both to make informed decisions. To illustrate, let's consider a few more examples and scenarios. Central bank announcements. Imagine the European Central Bank, ECB, is set to announce its decision on interest rates. Fundamental analysts will scrutinize the economic data leading up to the announcement, such as inflation rates and employment figures, to predict the ECB's decision. If the ECB raises interest rates, it signals a strong economy and could lead to a stronger euro. On the other hand, technical analysts might look at the euro to US dollar price chart to identify trends and patterns that could indicate how the market will react to the announcement. Economic crises. Consider the impact of an economic crisis, like the 2008 financial crisis. Fundamental analysts would examine the causes, such as the collapse of major financial institutions and plummeting housing prices, to understand its impact on currencies. For instance, during the crisis, the US dollar initially weakened due to economic instability but later strengthened as investors sought safety in the dollar. Technical analysts would observe the price movements and identify support and resistance levels to make trading decisions during the volatile period. Natural disasters. Natural disasters can also have a significant impact on currencies. For example, a major earthquake in Japan might disrupt the economy, leading to a weaker yen. Fundamental analysts would assess the extent of the damage and its economic implications. Technical analysts, however, would look at the price chart for the US dollar to Japanese yen pair to identify trends and potential reversal points in response to the disaster. Political events. Political events, such as elections or policy changes, can also influence currency values.
Consider the Brexit referendum in 2016.
Fundamental analysts examined the potential economic impact of the UK leaving the EU, predicting a weaker pound if the vote favored Brexit. Technical analysts monitored the pound sterling to US dollar price chart for signs of volatility and potential trading opportunities as the referendum results were announced. Global trade policies. Changes in global trade policies can also affect currency values. For instance, if the US imposes tariffs on Chinese goods, fundamental analysts would analyze the potential impact on the Chinese economy and the yuan. They might predict a weaker yuan due to reduced exports. Technical analysts, meanwhile, would study the US dollar to Chinese yuan price chart to identify trading opportunities based on the market's reaction to the tariffs. Understanding and mastering fundamental analysis can provide valuable insights into market movements and help you become a more successful trader. By following economic indicators and understanding their impact on currency values, you can better predict market trends and make informed trading decisions. If you found this podcast helpful and want to stay updated with more valuable insights and tips, make sure to subscribe to our channel, Traders Wealth Academy, and turn on notifications. We regularly share content that can help you navigate the financial markets and achieve your trading goals. Don't miss out. Subscribe now and join our community of informed traders.